Hi, this is Terence Vanderhood, co-host of Dollars with Sense radio show and podcast, here with my fellow financial guru, Ela Lange.
Good morning, Terence, and hello, everyone. Thanks for joining us. Comprehensive financial planning is our passion, and helping people grow and protect their wealth is our mission. Today's episode is a topic most of us don't want to think about. It's insurance. But it's an important topic, and one that we, as financial planners, consider to be a cornerstone of comprehensive financial planning. We care very much about the various major protection issues and needs facing younger Canadians, specifically those entering their prime earning years and who have young families to support and take care of. So today we'll cover the main protection issues you face. In essence, we will discuss how insurance works, how it protects you and your family, as well as your finances, should you die prematurely, become disabled, or face a life-altering illness. Think of it like your own personal superhero stepping in when times get tough.
That's right. Insurance is your superhero, and this discussion is around the three important protection issues facing Canadians who need to protect themselves from a sickness or accident through disability insurance, protect themselves from a life-altering illness through critical illness insurance, and to protect themselves from premature death through life insurance. Ella, why don't you start us off?
Okay, so I'm going to refer to a chart now that you'll see coming up on the screen. It's titled The Risk Management Framework. Just to illustrate how the three insurances we're talking about today, disability, critical illness, and life insurance, fit into our lives, and where we need the most in protection. When you will go to our YouTube channel and watch this podcast, you'll be able actually to see that chart come up within the movie. So the framework demonstrates that throughout one's life, you need both income and asset protection. And layered over this are the risk protection products. So that's critical illness, disability, long-term care, term, and permanent insurance. In your early years, your primary risk, of course, is the loss of income. Well, you can convert your human capital or your ability to earn an income into financial capital. And that your risk profile changes to asset protection. That's the bottom blue layer that you're looking at.
So looking back at risk management framework, a graphic that we have up on your screen right now. If you're listening to the radio, you can go to the YouTube channel. Just go to the YouTube search bar, punch in Ela and Terence. So look for the episode Insurance, Your Own Personal Superhero. And then you'll see, we'll talk about right now, we'll hone in down onto the critical illness, which is the brown bar that's just above the blue bar. As you can see, it's in the framework of where it's the best place to have it is somewhere between the ages of 40, starting at 40, and the need for it is no longer necessary in most cases at the age of 65. And this is again, as Ella said, these are the crucial years for a young family as they're growing. And the biggest asset that the young family has is actually, it's not their house, it's not their bank account, it's not their RSPs, it's their ability to work. And if you lose that ability to work, then you all your savings and all your efforts that go into building your nest egg will disappear so quickly. So we're going to, again, hone in on critical illness, the brown bar that's above the blue bar on our graphic. And so here's what you'd consider critical illness insurance. This insurance provides a one-time cash benefit in the event that you are diagnosed with and survive the waiting period, usually 30 days, for one of the covered conditions. Based on our claims, the most common critical illnesses are cancer, heart attack, and stroke. The cash benefit you receive allows you to focus on your recovery for providing funds to cover such things as your monthly mortgage payment or additional expenses you might incur, such as additional child care or medical expenses not covered by healthcare plan, and even a portion of your spouse's income. The need is highest between the ages of 40 and 55, as I said, although you may consider purchasing this cover for when you're younger or older. As a matter of fact, it can go all the way down to kids insurance, critical illness for your children. And we have a particularly good one here at Investors Group with Sun Life that has critical illness for head injuries for kids. So if an accident happens on the playground, which it does happen, then your child can be covered and for getting the best care possible and to help them grow into the adult that we all want them to be.
I think hockey is another one. If your kids are in hockey, man, I would think about critical illness with the head injury for sure.
Yes.
The next sort of area we'll talk about is long-term disability, LTD, sometimes we call it, and that's that sort of circular area from the ages of 30 to 55. Long-term disability is a good thing to consider there as well, because that's a monthly benefit to replace your income if you become disabled and you are unable to work. This insurance is needed while you are gainfully employed, again, earning your important dollars for today and later. Often people are covered through group insurance, that's true, but it's important that you understand any limitations on your group coverage, and owning personal coverage may be a good decision. If you leave your job, you leave your group insurance. So consider taking a minimum offered with your group and obtain the necessary with a personal disability insurance. At a time when the flow of regular income is disrupted by a disability, how are you likely to cope with new additional expenses? How, and more importantly, when you would even begin to think about retirement planning in the case of disability, what would happen in the long term? Would you dip into your savings? Are you taking out a personal loan? Or are you refinancing your mortgage on your home? And God forbid, do you need to borrow money from your family?
Well, these might be options for some, but let's look at what your other disability protection solutions are. The Canada Pension Plan does provide a taxable benefit after the 4th month of disability, but it has strict eligibility requirements and is intended for grave disabilities where there is little hope for recovery. The stringent definition of disability excludes most people, and the benefit amount is limited. Unemployment insurance offers a short-term 15 weeks only disability benefit, or an STD. Ew. Seriously, folks, on your payroll, you'll look on your payroll and you'll see STD, and that does not mean sexually transmitted disease. It does mean short-term disability. And some group plans have short-term disability in it. Also, employment insurance does have short-term disability benefits for employees, and qualifications are based on also strict criteria. For disabilities lasting longer than 90 days, EI is of little use, as it only lasts for 15 weeks, and self-employed people are not eligible for it because they don't contribute. Another one that everybody knows about is workers' compensation, is an employer-paid benefit covering work-related accidents and sicknesses only. It does not cover accidents or sicknesses outside of the workplace. While the benefits can be substantial, like 90% of your income, which is great that WCB gives that, but the workplace restrictions and the possible difficulty in claiming benefits makes this a limited solution. Yes, the unions will definitely have WCB, but the main weakness of the WCB, again, is that if an accident happens outside your job, you're not covered, right? And to be honest, most accidents happen outside of the job because we are very aware about safety at the jobs. I have an interesting example of a client of mine. It's really tragic, actually. Her daughter was out shoveling snow this fall, and she had just recently been divorced, like about 6 months ago or so, and she has 3 young children, and she slipped on the driveway and conked her head, and she was in a coma for 3 weeks. She is recovering, but she's really slowly recovering. And the client of mine is now paying out a large sum of money, close to $10,000 a month, to take care of the kids, to have child care taken care of. Her daughter lives remotely, so she's not able to be there, my client, to help her out. She's got to actually work herself to make the money to pay for it. And of course, she wasn't covered with any kind of workers' comp because it happened at home when she was shoveling the sidewalk.
On the flip side, I've got a client who broke her foot in the most horrible way off her mountain bike. And you know what? She has long-term care insurance. So after her short-term through her company expired, obviously, her long-term kicked in. And she's going to take a good year, 12 months to recover fully until she can, again, her job is mostly standing up, can go back to work. So thank God. And she said to me outright, thank God I have this insurance to help me get better for the next year. Yep. Long-term care insurance, again, the next bubble you'll see that overlaps the long-term disability, or we don't talk about it a lot, but long-term care can be thought of as a replacement for long-term disability during retirement. This insurance provides cash to pay for additional expenses associated with long-term care needs. You may want to consider purchasing it prior to retirement to lock in your health and to lock in, obviously, the good health that you're in to get lower premiums. Long-term care insurance provides a monthly benefit if you are unable to do 2 of the 6 activities of daily living or suffer from cognitive impairment. The monthly benefit amount you receive depends on where you are receiving care, if you are in a home or facility.
That's great. So we've talked about critical illness. One thing we didn't talk about with that was the odds of getting one of those 26 diseases, which is actually 1 in 5, so it's very, very common to be able to do that. Here's an interesting statistic. Your chance of getting into a car accident, which we all pay insurance for monthly, right? We all have to do our annual insurance on our cars. There is a 1 in 1,600 chance that you're going to get into a car accident. And yet, with critical illness, there's a 1 in 5 chance that you're going to get one of the 26 diseases.
Who doesn't have car insurance? Not one single person out there drives without insurance, car insurance.
Well, it is mandated by law, so it'd be interesting to see if it wasn't mandated by law, who would have. It would be pretty chaotic, actually. I wouldn't want that myself.
The odds, the way they're presented, though, is that you have more of an odd getting critically ill and not live with insurance as opposed to having a car accident and we're all insured.
So we should mandate critical illness then.
Wouldn't it be important, maybe? Well,
it would be important.
No,
I don't know. That's a different society, and we don't live in that one right now. So we'll move on with our discussion today. So we talked about critical illness, and we talked about disability insurance, which also has very high odds as well. I think it's 1 in 6 will have at least one disability claim in their lifetime. So again, an important part. So now what we're going to move on to is life insurance and how does that come into play. So as you age, your life insurance needs may transition, like going back to our framework here. You can see 2 different kinds of life insurance. One is the red arrow, which starts at a bottom portion at age 30 and then climbs as you go to age 85. That is known as permanent insurance, which we're not going to get into the details of that with this one. I believe we did that last time a little bit from a children's perspective. We called it the money tree. It's available on the YouTube channel. And then the second line, which is the blue one that has the bell curve on it and then drops down, is called term insurance. And again, at 30 years old, you could see, at the peak, around 45, 50 years old is when you need the most term insurance, and that's mostly due to your mortgage, your cost of living with your children, and basically that's the most expensive time in all our lives, and that's the time when we need to protect ourselves the most, because we have more than just us. We have dependents that are relying on us And if we get taken out suddenly and accidentally, that leaves a big gap, a big hole financially. Permanent life insurance is exactly that. It's permanent, and it stays on your life for the lifetime. Term insurance, though, covers a short term needed for larger liabilities, which for most people is their mortgage. An individual's needs upon death fall into two categories. Those that are always present, like final expenses, taxes, debts, creating an income source for survivors, which is an important part to it as well, and those that apply to certain ages and life stages. For example, younger people need to be concerned with children's welfare and mortgage protection, where older people have estate planning or estate equalization needs. So contrary to popular belief, protection needs do not always evaporate as you get older. They evolve and change shape.
If one were to die prematurely, how much capital would their dependents need to continue to receive an income that they were used to receiving? If one is earning $48,000 a year, you would need anywhere from $500,000 to $1.2 million to produce a similar income, depending on the investment return you could generate on that capital. I know, that sounds crazy. It's a lot of money. And this is where life insurance becomes important. By providing a sum of money, that's capital, that can be used to purchase an annuity or invested to provide an income, insurance is a cost-effective way of ensuring dependents continue to receive ongoing income, therefore protecting their financial security.
Let's look at a case study. John and Mary Smith, their husband and wife, and decide that one of them is to die prematurely. The surviving spouse will need about 60% of the deceased spouse's income to maintain their quality of life. So let's assume that John dies. He earns around $40,000 per year. 60% of that is $24,000. To replace $24,000 per year to protect Mary's income needs, John and Mary need about $400,000 of capital. This assumes a rate of return on their investments of around 6%. So again, when John passes on, and this assumes that he passes tomorrow, and he earns $40,000 a year, Mary will need 60% of that to continue on with the daily costs of living. And so that number was gained from having an interview with Mary and discussing what coverage they were looking for. So a lot of ways to look for, when it comes to insurance, to look for a good insurance agent is that they ask you and you come up with the numbers. That you are the one who comes up with how much coverage you're going to need. And then the insurance broker and the insurance agent or the financial planner like ourselves will be able to, we run an insurance needs analysis where we take the calculations of all aspects of your life if you were to die tomorrow and what you would want to leave behind. It's almost a process of having a will in place. So anyways, so John and Mary need $400,000 of capital income. So Mary and John have determined that they also require $170,000 to take care of immediate needs, like paying for John's funeral, covering his tax bill, because there's two certainties in life. One is death and the other is taxes. So to cover his tax bill, for paying off the mortgage so that the cost of living is lowered for Mary, and then creating an education fund for their children, because that still needs to happen. You still need to save for your RESPs, and you still need to save for your RRSPs for Mary. This means they require $570,000 at the time of John's death to cover immediate needs and to create an investment fund that will produce $24,000 per year for Mary. So how do they get $570,000?
Right. Well, for one thing, as we suggested earlier, they definitely need this insurance needs analysis done with as we said, financial planner or insurance broker to determine if they have a shortfall in their plan and by how much, so that a financial planner with an insurance license can match the appropriate type of insurance to their needs with premiums that fit their budget.
That's right. A comprehensive personal protection program, CPPP. Oh, no, that goes back to the Russia days. We better not use that acronym. Begins with a systematic evaluation that aligns your current situation with both your own and your survivors' needs and goals. So if Mary and John are in their 30s or 40s, they could cover their highest liabilities, like their mortgage, with a 20-year term insurance, which is inexpensive. As all things go with insurance, the younger you are when you apply, the less expensive insurance premiums are. In other words, insurance is always cheaper yesterday. And that's where the need for insurance becomes sort of crucial, because timing has a lot to do with it. And they could purchase a permanent insurance, which we won't get into great detail about, to cover their final taxes and legacies they wish to leave to dependents or charities. We've got another chart for you here called the Priority Pyramid that sums up the importance of solid risk management, as it is truly the foundation of anyone's financial plan. Setting up wills are part of this process. Once these issues are properly handled with the assistance of the appropriate professionals, one can concentrate on building your net worth, which includes saving for one's retirement.
Okay, yes. So we have this priority pyramid coming up on your screen, as we have suggested on the podcast, that you can find on our YouTube channel. We're going to throw out a couple of more stats that I think are pretty interesting. Did you know, Terence, that you have 1 in 14 million chance of winning the Lotto 649?
What? Okay, I'm out of here.
But a 1 in 3 chance of being disabled for more than 90 days before the age of 65. And another interesting fact is, when we go on holiday, what's the one thing everybody's talking about when you're booking your tickets and you're making sure your plans are ready and you've got your accommodation venue and so on and so forth? What's the one thing we can't go on holiday without? Well, travel insurance. That's another one. Why would we hesitate to buy proper insurance coverage for our own health, our homes, and our children's financial stability, which is so valuable, and never hesitate to buy travel insurance? Isn't that kooky?
That's crazy.
So yeah, if you're young and healthy, it would blow you away to know how affordable insurance, health insurance, critical illness insurance, or disability could be. Just a warning though, if you're a smoker, yes, it will affect the amount of premiums. So by all means, quit smoking. It'll take about 1 year for you to be a non-smoker to be eligible for non-smoking premiums. Just so you know.
That's right. That's right. That's the big, one of the number one questions when it comes to the insurance application is, are you a smoker? But speaking of the cost of smoking, here's another real-world scenario that's very interesting. This is a client of mine who was interested in seeing how much it cost her future self per cigarette. So look at the graph, which should be coming up on your screen now. The long-term financial costs of smoking that many smokers fail to really consider. Yes, oftentimes smokers realize that it's expensive to come up with the money for pack after pack of cigarettes day after day. I wonder, do people still buy cartons of cigarettes? It's like $150 for a carton of cigarettes. My goodness. Anyways, back to that. But they still fail to consider the long-term financial costs of smoking. Worrying about how to pay for the next pack of cigarettes is short-term thinking. Worrying about how much your financial future those packs of cigarettes are costing, that is long-term thinking. People who are wealthy or are well on their way to becoming wealthy tend to think long-term. This projection illustrates the value of smoking just one less cigarette per year and the savings used for a retirement plan.
Good. So Terence and I hopefully educated you guys out there about how important and wonderful insurance is to own, and it can be tailored to your specific needs. It's, a step towards your personal superhero. When times are tough, remember, and you have other concerns, money is taken care of, so you can concentrate your time and energy on getting better and on where it counts. Please take this genuinely. We are asking you to take this seriously. And we're going to leave you with an action item, which is to seek professional advice, either from a licensed insurance provider like ourselves, or of course, discuss it with your financial planner. And if you don't have one, you certainly know who you to call, because you need a needs analysis, an insurance needs analysis done to choose premiums that fit into your budget and your family's budget, and as soon as you can. If you're young and healthy, and even if you have health issues, the insurance carriers will make exceptions. There are ratings. There will be ways to achieve and attain insurance regardless of the situation you're in. It's never a guarantee. I'm not making any guarantees on anybody's behalf, but at least go out and see what is out there for you.
That's right. Make sure that your action item, again, is to get yourself insured properly. It doesn't cost nearly as much as you think, and it certainly is great for peace of mind. That's it for this week. Thank you to everyone at 98.7 CKPM FM, The Point radio station, for giving us the time to be your financial gurus by offering you, the listeners, valuable financial insight. Check out our Facebook page at Dollars with Sense. Our podcasts and transcripts are there. You can leave a comment with us, and we'll certainly get back to you. You can also reach us by email at twofinancialgurus@gmail.com. That's the number 2financialgurus@gmail.com. You can call us by phone as well at 778-879-0820. You can also reach us by YouTube. This is where you'll find this episode's and 39 others. Just go to the YouTube search bar and type in Ela and Terence, and our channel will be at the top of the list. And you'll be able to check out our other episodes at your leisure while you're there. Subscribe to the channel, and you will automatically be notified when the new episode is ready for your listening pleasure.
Again, on behalf of Terence and I, thank you very much for tuning in today and joining us on this episode of Dollars with Sense. We hope you found it useful. We look forward to speaking to you again next week and share another knowledgeable, packed episode with you. Until then, have a productive week,
and may your dollars and cents be with you.